Good day, and thank you for joining. The following presentation and analysis stems from Procter & Gamble's business venture pursuit to launch Crest Whitestrips Advanced Seal in the United States of America. The need for analysis arose not only from a base profitability perspective, but also from the identification of various financial factors that may present definitive challenges to the commercial success of the venture. To analyze this most effectively, various NPV analyses have been conducted to ensure definitive direction is indeed provided. On the agenda for today, we have a base NPV analysis initially. Thereafter, break-even analysis is provided. NPV calculations of various launch methods is then followed. NPV analyses of these launch methods is then expanded upon. Before we start, I would like to introduce the presenters and speakers today. You have myself, JP Nal, Thavashalan Pillay, and Hassan Kassim. Thavashalan will be providing comments in detail regarding technical NPV analysis and resulting figures, whilst Hassan will conclude with explanatory comments and the analysis thereof. To start, the various assumptions guiding this project are as follows. The weighted average cost of capital has been calculated to be 1.5118%. A 3-month average direct exchange rate of 14.69 Rand to the US dollar is used. Finally, the project lifespan is 4 years. The analysis starts with a base NPV analysis. This analysis holds information on the calculated yearly operational cash flow, premium and basic cannibalization, which refers to the erosion of two existing products, one a premium brand and the other a more basic version. After taking into account the changes in net working capital and costs, a final NPV, a staggering 14,589,703.73 US dollars, equating to 214,363,598.95 ZAR is realized. Thus, the initial base NPV analysis indicates a rather attractive and profitable venture. The break-even analysis includes the accounting break-even and the present value break-even. The accounting break-even equates to 750,000 units, whereas the present value break-even accounts to 1,148,399.85 units. What this means is the point where the project generates no profit or losses is calculated to be 750,000 units. However, the present value break-even point indicates the minimum sales level needed in order for a project to break even. As per financial projections, it has been estimated that the venture will result in year-on-year sales revenue of 2 million Rand. Given that this is rather substantially larger than the present value break-even point, the resultant conclusion, in line with the base NPV analysis, is that the project will be profitable and should be pursued. However, the base NPV analysis does not cater for various scenarios that may play out that may or may not hinder the financial success of the venture. My group member, Thavashalan, will provide a greater detail and specificity regarding this.
Thank you, Mr. Nal, and good day, everyone. It is my absolute pleasure to be part of this fantastic new product launch of Crest Whitestrips. It is my duty today to take you through our 7 NPV analyses that the team was able to hypothesize. Please note that these are rounded off figures, and I have emailed to everyone a detailed breakdown of these values. Let's begin with case 1. Christina had worked very hard to produce the scenario through intense advertising, allowing for an NPV value of 200 million rands. Anna thereafter had a major breakthrough in R&D, allowing for 50% better whitening results, producing cases 2.1 and 2.2. Case 2.1 involved a $1 increase in the price, whereas case 2.2 allowed for a $2 increase in the price. These produced NPV values of 184 million and 190 million for the former and latter respectively. As you can see, these however lower than Christina's initial case 1 above. Thus, we decided to combine the efforts of our brand manager and the R&D department to produce cases 2.3 and 2.4. As you may see on my screen, these allowed for NPV values of 167 and 176 million respectively. However, these were lower than the 3 independent cases described above. Thus, we had to take on a whole new launch program, producing cases 3.1 and 3.2 by Christina and Margaret. Case 3.1 involved higher cannibalization, whereas case 3.2 involved lower cannibalization. These produced excellent NPV values of 217 million and 221 million for the former and latter. As you can see, the comparative view on my screen, it is case 3.2 that produced our highest positive NPV value of a staggering 221 million rand. Thank you, Christina and Margaret. Your hard work and efforts throughout the project does not go unnoticed. I will now hand you over to my colleague Hassan, who will now round up our presentation. Thank you for your attention.
Thank you, Tavarshan. Good day, everyone. I will be informing you about the financial benefits of this exciting new venture and assess the risks associated with launching this product in the United States. Let us begin with an NPV analysis and the short and long-term benefits of this project. As Tavarshan has explained, our case 3.2 yielded the highest positive NPV of approximately 221 million, making this our best scenario that will pay off for the company and its shareholders. The launch under our base case would yield a net profit after tax of approximately 88 million, which will help the company in fulfilling its financial needs. Any excess income can be redistributed to shareholders or be reinvested back into the company for future projects. This project's strong cash flows would help with our recent research project to simplify our portfolio from 100 brands into 65 brands. Launching this project in the United States is a promising move as they have a strong healthcare market and the consumers are far wealthier than those in developing countries. We need to ensure that we differentiate ourselves from our competitors as the superior brand in order to drive sales. One of the ways in which we can do this is by using a celebrity endorsement as a public relations tool in order to improve our household penetration in the United States. As an exporter, we need to mitigate any exchange rate risk and credit risk between the United States and South Africa. Due to the recent COVID-19 pandemic, South Africa and the United States have slipped into a recession. Although oral care is deemed essential to maintain hygiene, we need to consider any adverse effects that this pandemic might have on manufacturing and exporting. One of the ways in which we can overcome these operational risks is by collaborating with various different suppliers from various regions in order to minimize our organization's reliance on a single supplier. Evaluating this project from all these various aspects, our case 3.2 produced the highest positive NPV of approximately 221 million rands, and thus will be the most advantageous to launching this project in the United States. The accounting and present value break-even estimates show that the projected revenues are well over the number of break-even units required. Considering our growth acceleration plan, possible competition in the United States, various risk mitigating strategies, and our consideration for the economic climate, we believe that Crest Whitestrips Advanced Seal will be a profitable opportunity for P&G, and thus the project should be undertaken. Thank you.